The financial services space in Malaysia is witnessing transformational change at speeds it's never seen before, brought on by shifting consumer behaviors, rapid digitalization, and a constantly evolving regulatory framework. Arguably, one of the most impactful regulatory initiatives we've seen in recent decades is the introduction of the digital banking framework. Ever since Bank Negara Malaysia introduced the framework in late 2020, the excitement in the air is palpable. 29 players ranging from conglomerates, state governments, telcos, fintech startups, and more are all clamoring for the 5 licenses that Bank Negara Malaysia is looking to dish out in 2022. So why did Bank Negara issue this new framework, and what are the outcomes it is hoping to see from it?
When we first thought about developing the regulatory framework for digital banks, it was mainly driven by the increased trend of digitalization that brings promise of improved efficiency and ability to serve the unserved and underserved markets. At the same time, we were seeing establishments of challenger or digital banks with new business models in other parts of the world, for example, in Europe, UK, and even in Asia. The existing licensing framework itself is catered towards entry of more established banking institutions. Existing requirements such as fairly high minimum capital funds of RM 300 million and full compliance to the regulatory requirements may also make it difficult for a new and innovative players to enter the market, which will need time to basically build their balance sheet, right? So with this in mind, we decided to customize the existing licensing framework to attract new entrants, while taking a balanced approach to ensure that the adapted framework achieves the benefit that we want, as well as manage the risk that we are concerned with. So the customization takes into account 3 principles that we practice in our approach to facilitating innovation. I'm sure you have heard me saying this in the past, proportionality, parity, and neutrality. So given the benefits and risks mentioned earlier, we decided to introduce what we call a foundational phase, where in the first 3 to 5 years of operations, digital banks are subject an asset limit of 3 billion ringgit to minimize the risk to stability. In line with the proportionality principle, this asset restriction is balanced by allowing digital banks to comply with a more simplified regulatory requirement.
While Bank Negara Malaysia seemed to have baked in the foundational phase within the framework to enable new innovative players to throw their hats in the ring, how does the industry view the framework? Khairil, the CEO of Axiata Digital, is in favor of this new regulation. His company, alongside RHB Bank, is bidding for one of the 5 licenses.
In short, we like it. We like it because it's a very balanced framework where it covers the needs of, if you like, innovation, application to new technology, the need for financial inclusion, whilst maintaining proper risk management and controls that would be required for any kind of banking services, any kind of products and services that we would roll out. So I really like the fact that it has those progressive elements that allows us to experiment and build products and services out of the technology that we're deploying, but at the same time has all the sort of risk controls that are necessary to ensure that we provide services that meets the requirements, but also meets kind of the customer's expectations on their protection. I think the other thing I would also say is that it creates quite a to some extent a level playing field. I've seen frameworks where they tend to kind of promote incumbents from sort of creating digital offshoots, but this framework actually is in a sense quite fair, because it not only allows fellow incumbents to pursue, if you like, digital propositions, but it allows fintechs like ourselves to also bid for it.
Axiata's partner, RHB, seems to echo these same views.
Today in Malaysia, there are about 10 million customers that have been underserved by the current financial services or banking providers. So that is quite an urgent need for Malaysia to provide good banking access and help them to improve their lives. Typically, this group of customers, what we so-called underserved, it requires a sustainable business model to support them. The current banking model hasn't been able to fulfill that objective as much as we want. Therefore, we need a new way of doing banking.
International players like Temenos also welcomes Bank Negara Malaysia's move in introducing the digital banking framework, citing that it is prime time for digital banking in Malaysia.
We see the era that we're in now as the decade of digital banking. The banking industry is going through some drastic changes, driven by the generation of digital natives, and this has been, fast accelerated by the pandemic. Southeast Asian countries have some of the youngest populations in the world, with some of the highest concentration of digital natives and smartphone users. By 2040, it is projected that 1 billion relatively young and extremely digitally savvy people will demand financial services across Southeast Asia. This paired with regulators fostering innovation and the number of entrants in the digital financial services space promises to push Malaysia, in particular in Southeast Asia as a whole, to the forefront of a blooming digital economy.
Standard Chartered Bank shares similar views, although they have not pursued a digital banking license in Malaysia the same way that they have in Hong Kong, Singapore, and in the African continent. Sammeer Sharma, who heads Standard Chartered's consumer, private, and business banking in Malaysia, said the regulation will bring about a lot more vibrancy to the market. As an incumbent bank who is not pursuing the digital banking license, Sammeer said that Standard Chartered will instead focus on two core pillars.
The three different approaches, which is inventing new business models, digital partnerships, transforming our core. We are focusing on the second and third pillar. So the second one, which is digital partnerships and partnership for scale, is all about leveraging on existing platforms, right? Leveraging on technologies which are already available or platforms which are sufficiently mature in terms of how they are engaging their clients right now and partnering with them. One good example in the area that we're embarking on as we speak, which was just announced recently, is the partnership with Atomy. We have invested $500 million. It's a 10-year partnership for multiple Southeast Asian markets, Malaysia being one of them. The second, obviously, is to strengthen our core and transform it digitally, which is the core bank itself, right? So we are an omni-channel bank. We want to move from being omni-channel to omnipresent. So it is giving access through all channels that are available to a traditional bank, but now moving digital and virtual and making it more seamless, friction-free, and easy for our clients. So that's the approach we're taking. Digital partnerships and transforming the core digitally.
Players like Temenos are bullish about the prospects of digital banks in Malaysia, and they are confident that they will be able to ride the wave.
Temenos is really the platform of choice for banks worldwide. Temenos powers banking for 1.2 billion people worldwide, and we do that today in over 150 countries. We help over 3,000 clients accelerate their end-to-end transformation, and we do this from the largest of Tier 1 banks to mid-tier and challenger banks and fintechs. We count more than 70 challenger banks amongst our clients, and I'm going to give you a few examples that we're particularly proud of. WeLab Bank is Hong Kong's first homegrown virtual bank, and it uses Temenos Transact to provide a range of next-generation digital services for customers to enjoy 24/7 from their mobile phones. It was designed, built, and launched in less than 10 months. This is a fully digital bank, and it's seen a very, very rapid take-up with a reported 10,000 account openings within the first 10 days of launch. It is the first multi-cloud digital bank in Hong Kong, so that means that it operates on multiple clouds at the same time, and this provides increased operational resilience and obviously disaster recovery capability.
When all is said and done, what shape or form will digital banks in Malaysia take, and how will it be different from what we already have in the market? Khairil's vision for the Axiata RHB consortium gives us a sneak peek of what we can expect.
The way I would do it is, First of all, start with drawing up the entire value chain of the process, right? And maybe one example would be lending. And what you do is you draw up the entire process of lending. And then you go on to what I would call Jenga blocks. I don't know if you've ever played the game Jenga blocks, but it's that game where you build a tower with blocks and you start removing each individual block to see sort of when the whole thing will collapse. So the concept here is you look at that value chain, see what steps you can actually remove. Because every step that you remove, you're actually sort of simplifying the process, removing costs in the operations. And then once you've done that, you're going to now have a much more streamlined process. But then the remaining steps will be then to kind of think about what technology or what new regulation that you can deploy that would allow for disruption of that particular step. What you get as a result is a product or a service that has super low cost to serve. And because digital technology is leveraged, the marginal cost of doing some of these individual steps might be as close to zero. And that will allow us to sort of develop products and services that actually are at affordable price points for the underserved segments perhaps to actually afford. I think if you look at the history of what Axiata has been doing through Boost today with our lending product, you will get a, if you like, sneak preview of what we intend to do with the digital bank. We are right now serving that underserved segment, right? The makcik nasi lemak, if I can call them that, the char kway teow uncle and SS2, where we provide them with working capital loans, a supply chain financing, very low ticket sizes, as low as 500 ringgit or even smaller than that. And these are the kind of ticket sizes that the typical incumbent bank will find it very, very difficult to serve, because the net interest income from those kind of loans will make it impossible for them to actually make any money, irregardless of the kind of interest rates that they may be charging to the SMEs, right? So we're looking after those segments. We're going after those segments with the new digital bank consortium that we're building with RHB.
Market observers are predicting that Bank Negara will be announcing the recipients of digital banking licenses during My Fintech Week, a flagship fintech event organized by the central bank happening in January 2022. Though we will be finding out about the licenses soon enough, it will still be some time before we see this new breed of banks in action. In other markets where similar licenses have been issued, it typically took more than a year for these digital banks to go live. While they will certainly bring a lot of exciting new innovations to the market, much like digital banks in other markets, they might find themselves struggling with profitability and talent issues, at least within the first few years of inception. With many strong contenders among the 29 applicants, Bank Negara Malaysia certainly has its work cut out for itself.